Carlyle Group's co-founder, David Rubenstein. David, it's great to have you. Thanks for joining us today.
My pleasure to be here. Thank you for having me.
You've been pretty clear, even when the market sort of doubted it, that inflation would be persistent. Do you regard these last few weeks as the market coming around to what Chair Powell has been trying to get across for months?
I think the market is finally recognizing that inflation is not going away. The Fed is resolute. They made it clear several times recently that they really want to get the rate down to inflation rate down to 2%, not 3%. And therefore, I think the market takes the Fed very seriously. But that doesn't mean we're going to have a hard landing or a so-called recession. It's just too early for anybody to really know where that's going to happen, or not.
Do you think, David, it's Sarah, that the market got too excited just over the last, I don't know, few weeks and month about a Fed pause and a Fed pivot? You spoke to Fed Chair Powell. I don't think he sounded particularly dovish. Do you?
Well, I don't want to characterize it, but I would just say that he made it clear that they are determined to get the inflation rate down. And I think the earlier expectation that maybe there would be rate cuts by the end of the year, I think that's out the window based on what we now see and what he now sees. Clearly, the market could change, the world could change. But based on what the Fed sees now, while I'm not obviously authorized to speak for the Fed, I think the Fed is probably not going to decrease rates this year. And that, to some extent, is being reflected in the stock market.
What about the deal environment, David? I always like to ask you what you're seeing in terms of deal flow and, really obviously dried up last year. 2023 look different?
The market is getting better. I mean, obviously, there's fewer deals being done than people in the business world would probably like, or at least in the deals world. But I know there are a number of deals in the works, and I do think that there is debt available for well-structured deals at reasonable prices. There is debt there, not just from the banks, but from other lenders. So I do think you're going to see more deal activity in the next few months, and I just believe that the principal problem we've had recently has been that people were expecting a recession, and therefore buyers were reluctant to buy into a recession. It's not clear whether they expect a recession or not right now, but I think people are beginning to lower their expectations. Sellers are getting somewhat lower in what they wanted to get from prices when they sell. And I think buyers are maybe stepping up a little bit more. So I think you'll see more deal activity. The gap between buyers and sellers is not quite as great as it was, let's say, 9 months ago or 6 months ago.
That's interesting. And to extend that a bit to, say, the equities in the IPO market, I mean, the Journal and others have done some stories lately about budding interest in, say, online gaming and restaurants and even some areas of tech that might eventually find a window to come to market. Do you think that ends up being a Q2 dynamic, a second half dynamic?
It's hard to say, but I would say you have to recognize that there's a fair amount of growth capital out there now. And I think that money can be used to extend a company's stay as a private company. It used to be that after 2 or 3 years as a reasonably profitable company, you would go public. Now you can get more growth capital to grow your company. And the need to go public isn't quite what it was many years ago. So I think it may take a while before you see people coming to the market at the prices they're happy to get.
So higher for longer and private for longer in a sense.
Well, we have more privately owned companies now than we have publicly traded companies, for sure. And that's because being in the private market, that has some appeal to people. So I don't think you're going to see a rush of IPOs right away. It'll take a while.
What about private equity in particular? Because we're seeing more public companies go private via private equity buyouts than actual public IPOs. And in your forecast that you just gave, you expect more deals this year. Does that include from private equity? How much of a driver?
When I talk about deals, I'm talking about venture capital, growth capital, and other kinds of things. But in terms of companies going private, there's a lot of appeal to being a privately owned company, for sure. A lot of less regulation and oversight and so forth. So a lot of CEOs and a lot of boards are saying, well, maybe we'd be better off to be private for a while, fix some of the problems we have outside of the viewership of all public traders, and then we can fix the company and take it public down the road. And you're seeing more and more of that.